So good morning, distinguished participants. On behalf of Transact Chartered Accountants, I would like to warmly welcome you to today's webinar titled Why Most Nigerian Companies May Fail the FRC Sustainability Reporting Guideline 1 and IFRS S1 S2 Readiness Test and How to Avoid It. My name is Taiwo Akinyode, a Senior Manager in the Audit Department at Transact, and I'll be your moderator for today's session. Over the last few years, sustainability reporting has moved from being a nice to have to becoming a key business and regulatory requirement. With the introduction of the Sustainability Reporting Guideline 1, SRG 1, and the adoption of the IFRS Sustainability Disclosure Standards, which is IFRS S1 and S2 in Nigeria, organizations are now expected to go beyond simply talking about sustainability and begin demonstrating measurable preparedness and compliance. While many companies are aware of these new requirements, awareness alone is not enough. The real challenge lies in understanding what compliance looks like in practice, identifying readiness gaps, and taking the right steps to address them. That's exactly what today's webinar is about. This webinar is designed to provide participants with a practical understanding of SRG1 requirements and expectations, helping organizations gain clarity on what is required to achieve compliance within the evolving regulatory landscape. During this session, our speakers will break down the key requirements of SRG1 and IFRS S1, S2. They will discuss the common pitfalls that may prevent organizations from achieving compliance and share practical insights on how companies can assess their current readiness level and develop a clear path towards implementation. We are delighted to have you with us today, and we hope you find the session insightful, practical, and engaging. Thank you for joining us. And without further ado, let's get started. This webinar is proudly organized by Transact Chartered Accountants. Transact is a leading accounting and advisory firm in Nigeria. Founded in 2009 by seasoned industry professionals, Transact has built a strong reputation for delivering innovative, practical, and value-driven solutions to businesses across diverse sectors of the economy. With a team of more than 70 professionals dedicated to serving the middle markets, the firm offers a comprehensive range of services across audit and assurance, accounting, taxation, advisory, consulting, and outsourcing solutions. Our partnership with RSM empowers us to leverage global best practices while maintaining a strong local focus. Transact is committed to providing clients with world-class services that combine global standards with a deep understanding of the Nigerian business ecosystem. For more information, you can visit our website as shown on the screen. To ensure we get the most value from today's session, we have structured the webinar to include an opening presentation, followed by a moderated Q&A session focused on practical challenges and solutions. Throughout the sessions, we encourage you to actively participate by sharing your questions using the chat feature. Our speakers will address as many questions as possible during the question and answer segments. So please, don't wait for the end. Feel free to submit your questions as they come to mind. So before we dive into today's discussion, we'd like to get a quick sense of where everyone is on their sustainability reporting journey. So we'll be putting up a poll. Take a moment to select the option that best reflects the organization's current stage. Oh, okay. So we would come back to the poll later. So let's move on. To guide us through today's discussion, it is my pleasure to introduce our first speaker, Akim Taufik. Akim brings over 18 years of experience as an internal and external auditor, leading audit engagements across FMCG, oil and gas, energy, capital markets, and financial services. Akim is a fellow of the Institute of Chartered Accountants of Nigeria, an associate of the Chartered Institute of Taxation of Nigeria, a reporting accountant, and a global member of the Institute of Internal Auditors. Akim also served as Group Head, Internal Audit, Meristem Securities Limited. Prior to him becoming the Director of Governance, Risk and Compliance at Transact, he was the Director of Audit and Assurance Services. To set the context for today's discussion, I would like to invite Akim from Transact to share his insights on how evolving sustainability reporting landscape. Okay, I would like to invite Akim from Transact to share insights on the evolving sustainability reporting landscape, the difference between awareness and readiness, and practical steps organizations needs to take to achieve compliance with SRG1 and IFRS S1 and S2. Akim, the virtual podium is yours.
All right, Taiwo, thank you very much for the intro, and good morning, participants. We thank you for joining our webinar today on sustainability reporting. What are we seeking to achieve today is to clarify SRG1 and IFRS S1 and 2. We have in our midst an able representative from the Financial Reporting Council of Nigeria that will do justice to SRG1, and I will focus on S1 and S2 with respect to identifying readiness and implementation gaps. We are going to talk about the governance, system, and control requirement, and provide some practical steps to be able to achieve readiness, because readiness is something that is now under the purview of FRC. Before you go ahead and implement, you have to demonstrate sufficient readiness to the FRC Financial Reporting Council, which is why we have our able representative with us. Before now, we've been disclosing ESG in our annual reports with management construct. Management decide the level of disclosures that they want to provide from an ESG point of view, which is more voluntary. But now we are moving into a mandatory space where the Financial Reporting Council has provided guidelines and transition to ensuring that it become mandatory, and also the limited and eventually reasonable assurance is provided over that particular space. And how do you ensure that when it's time for the audit aspect of sustainability reporting, will be ready for your auditors or the auditors that will perform such a responsibility. So these are things that we need to look at moving forward in our sustainability reporting journey. Let's move on. What do we have as our reporting architecture as at the moment? Just a quick reminder to what sustainability-related risk and opportunities are. Just to quickly remind us that what we are discussing is about disclosures around sustainability risk-related and opportunity. Our business is all about survival and, more importantly, sustainable continuation of running the business regardless of the global shocks or future occurrences. So just to let us know that we have both climatic aspect of the risk, which is governed by IFRS S1, S2. Then we have the main standard, which is IFRS S1. We talk about the disclosures on all sustainability related risk. Please move on. Now, the disclosure itself is anchored on 4 pillars. We have the governance, we have the strategy, we have the risk management, we have the metrics and targets. And what are we trying to say here? We all in our business, we go through budget section, we go to strategy section on an annual basis. I've been in so many such gatherings where we look at strategy, we look at budget, we look at how we are going to set objectives for a particular time horizon, usually 1 year budget. So the disclosure is just telling us now those things were internal to us. We do monthly performance reporting, we do quarterly performance reporting, and we also do half yearly reporting. Those things are internal to us, but with IFRS S1 and S2, they are going to be much more transparent in terms of external reporting now. So we are more going to be saying things regarding sustainability aspect of our conversation vis-a-vis our strategy implementation, our strategy formulation, and monitoring of strategy. We are going to be seeing that in our financial statement as a matter of disclosure that is required by IFRS S1 and S2. So that is what is going to be expected to moving forward. Just like we have our ICFR, where we have some disclosures around ICFR from the management point of view, we're also going to be having disclosures, extensive disclosures, narratives around sustainability related risk and opportunity in our financial statement moving forward. That is basically the outlook from a financial reporting point of view. But there are so many things behind the scene that has to be put in place before you are able to provide credible, reliable disclosure around sustainability reporting for the purpose of meeting the requirement of the standard and also the requirement of Financial Reporting Council of Nigeria. Please move on. One critical thing I have to say at this junction is the fact that there is no disclosure in sustainability that is not connected to the financial statement. You must show the connection to the financial statement. Whether we like it or not, some of our strategy, I'll give you a good example of the deregulation of the oil and gas sector, where we now have domestic refining capacity. And I used to ask one of my friend in one of the oil depot businesses that this is a sustainable risk for you, where Nigeria is going the way of domestic refining, and your whole model is based on importation. And I told them that if you are looking at it from an accounting point of view, you'll be talking about impairment. But if you are looking at it from strategic point of view, from a business model point of view, then you are talking about sustainability of that business with respect to the future of Nigerian oil and gas downstream. And now that we have this sustainability reporting and the company is obviously a public interest entity, obviously they will be thinking in that direction, that how do we ensure that we are sustainable and will provide the right disclosure in the financial statement moving forward. So there must be connection between your narrative with respect to the disclosure requirement and the financial statement. If we say something is happening from a strategy point of view that has material effect on financial statement, we must be able to see substantially how the numbers will be changing in terms of your cash flow, in terms of your cost of capital, in terms of your source of finance. Well, these are the 3 entities prospect. These are the 3 major aspects that the standard wants disclosure around, which is your cash flow, your cost of finance, and the sources of finance itself. So on a sustainable basis, the impact must be disclosed in the financial statement. So where there's a disconnect between sustainable reporting and financial statement, obviously the purpose of SRG may not have been achieved by that particular organization. So that is something that we have to take home today, that it is not business as usual. You don't disclose something on your sustainability reporting disclosure and there is every possibility that it has impact on financial statement, and you are not disclosing the impact on financial statement too, then you may have failed the test of readiness from day one. And to avoid that, that is why we are here to share experience and practical insights to be able to ensure that doesn't happen. Please move on. Now, what we are here to let you know is that you may be aware of the requirements. Basically, you have the IS1, IS2, then we have the SRG. You may have policies that you're already aware of. You may have some narrative you've been dealing with, and you may have an understanding conceptually. But in terms of readiness, then it shows that you are ready to implement. It shows that you have some processes in place already. It shows that you have tested the processes. It shows that you understand the data challenges and data constructs that come with sustainability reporting. It shows that you have developed an audit-ready ecosystem that ensure at the end of the day, when it's time for audits, whether it's limited assurance or reasonable assurance, you are able to provide the right information for the auditors to provide that particular assurance service. So your readiness is key, and which is why FRC has made it so mandatory that before you go out full-blown, you have to demonstrate your readiness to FRC with respect to the key requirements that are meant to be implemented. Please move on. Then why do companies struggle? And we don't want you to struggle. That's why we are having this session with you. One of the key reasons why organizations struggle is ownership and oversight. This is very key. You don't know who owns what. You don't know who has oversight over what. We have experience in the ICFR. And in order for such not to happen with sustainability reporting, the idea of having unstructured, unclear ownership and oversight has to be dealt with. For instance, this is not really an accountant, I'm the head of account, I'm the head of finance. No, you are part of the process because there are so many coordinated, collaborative efforts in terms of data, in terms of knowledge, in terms of insight that comes together to ensure that you have a robust sustainability reporting architecture and framework within your organization. So that ownership has to be clearly defined. Data is very important. Most of these data are not necessarily in our accounting ledger. They are not in our sales. They are not in our ledgers that we use for preparing financial statements. They are mostly non-financial information that can be translated to financial information that will be useful for disclosure and also help to understand the impact on the financial statement itself. So these data, if they are fragmented, if they are not in a way that ensure that they flow for proper analysis and proper use, most likely such an organization will fail. Then system integration, like I said, this is not about finance alone. You have the HSC, you have the HR, you have the supply chain, you have even the legal, because the sustainability reporting affects the legal, it affects supply chain, it affects talent shortage, it affects geopolitics and so many other aspects of things that you need to consider. So all this has to be looked from a business point of view. We are discussing business resilience. We are not discussing business survival here. And when you say business resilience, it means the entire business has to be coordinated in a manner that ensures that the requirement of the standard is implemented and properly disclosed in the financial statement. Please move on. So the biggest issue is not that you are aware of it, is that you don't have processes and systems to back it up. That is the biggest issue that you must be aware of. You must have processes that is repeatable, and you have controls that is repeatable. And more importantly, which is why the Financial Reporting Council through the SRG actually emphasize internal control over sustainability reporting. This is not internal control over financial reporting. This is internal control over sustainability reporting to ensure that there are processes that are repeatable, that are consistent, and that are adaptable to changes as the ecosystem that underpins sustainability reports also change. Please move on. Now, I've spoken to the data challenge, And this is just to let you know that the data we are looking for does not sit with this finance alone. It sits with almost all business functions that contribute to the business resilience construct of your organization. How do we survive? Not just survive, how do we ensure that if there is a shock, we are able to absorb it, and not just absorbing it, we are able to come up stronger after the shock, and we're able to ensure we continue to generate enterprise value for the lenders, for the investors, and for creditors. So we have cases of environmental issue that is affecting the company. You have cases of supply chain. Look at what happened during the Iraqi war. Many organizations are affected simply because of destructions of oil import and export across the globe. These are real life sustainability issues that needs data from different sources to be able to feed into the architecture for the sustainability reporting. And more importantly to say here, because the scoping of disclosure here, in terms of what you need to do, they're into three scopes: scope 1, scope 2, and scope 3. The scope 3, which are external data, this is very critical. We need to make sure that we understand this external data because these are our customers, these are our suppliers that we really have control over, but we need data that relates to their activities that connect to us within the ecosystem. And more importantly, the data here, they are more assumption driven. They are more estimation driven. They are not numbers that you can easily just pick from your own accounting system and say this is number. There are numbers that are one, you could be either out of your control, or even if they are within your control to an extent, you still have to validate their reliability when you are making such disclosure. So data is a big issue here that we have to let you know that data for ICFR preparing financial statements. Once you are with the finance and accounting, I think we are substantially okay. But with respect to this discussion on S1 and S2, it goes beyond the finance team. It goes to even the legal team, even the supply chain, even the lawyer. Everybody has a role to play as much as we have been able to evaluate the implication of the environment where we operate, our ecosystem, our value chain, where we operate with respect to our business resilience. Please move on. Now, from a governance point of view, we are sharing what does a governance look like. We just want to let you know that for this thing to work very well, these are like a prescription for governance. The board, the audit committee, as the case may be, will provide the oversight and challenge at the highest level. Then you have the executive management that provide accountability and resource allocation. Then more importantly, depending on the structure you have, I've seen a structure where the CFO is the owner of sustainability reporting as a whole. I've seen it in some cases. I've seen cases where there are dedicated sustainability reporting professionals function that their work is just sustainable. Perhaps more often than not, when you have businesses on a global cross-border basis, they are more likely to have specialized people that deals with that in coordination with the finance team that ensure that because a discipline is a big area, a big discipline that has come to stay, and is something that is going to be with us as long as we continue to have need to survive globally, as long as we have a need to survive from the climatic conditions that we are witnessing in our lifetime. Then we also have the process and data owners. All this must be clearly provided for during the process of even showing that you're ready for this particular implementation that is going to come up in the near future. Please move on. Okay, now my experience so far with ICFR is not necessarily different from what one can apply here to sustainability reporting, but it's an upgrade. if you understand very well ICFR, which is Internal Control of Financial Reporting, if you understand it very well, if you understand the importance of it to financial report, and you have applied it in your organization, then you are just one step to understanding how the same internal control can play a major role, a big role with sustainability reporting. Because where the ICFR stop is where the sustainability picks it up. Because under the ICFR, we already have our management report, assessment report, then we have our certification. Now we are adding another layer to it. The layer is now on sustainability reporting. So management will also certify and do assessment of sustainability reporting. So we may be having two more reports along with the ICFR. But this particular report is more detailed, is more challenging, is more all-encompassing. Like I said, it's beyond just the finance, really. So if you understand the construct of ICFR, then from the internal control point of view, you're almost there to understand how to build an internal control over over sustainability reporting. It's something that the lesson whatever you've gained from that ICFR is going to be very useful for you to be able to build and rely on and build for ICFR internal control over sustainability reporting. So have that in mind, that if you have succeeded in implementing ICFR, there is a more likely chances that from a control point of view, you are going to have a smooth ride when you are building your internal control over sustainability reporting, because you are going to rely on that architecture of COSO. You can rely on it and build more with respect to all the different perspectives that come with sustainability reporting. Move on. Now, how do you know that your data is ready? How do you know your data is ready? Because by 2030, March by 2030 for the SME, that's 2030 for the SME, everything that we are talking about will become ultimately mandatory. And by year 6 and 7, we are going to be looking at assurance aspect of it. By year 6 and 7, we are going to be looking at assurance aspect of this particular journey that we are. But the question is, do you have to wait till then to think about assurance? No. Then you have to start the journey now. To start the journey now, your data has to exhibit some characteristics. The first one is traceability. Your data must be easily traced back to the source. And what do I mean by source? If the data is emanating from supply chain, then we must be able to trace it by the supply chain. We must be able to trace it by the supply chain, and we must be able to verify it. We must be able to verify it. We must be able to reproduce a process consistently over time. Then your data must be consistent period by period. So your data has to pass this 4 tests: traceability, verifiability, ability to produce the process on a repeated and consistent basis, because it's going to be an annual thing. It has come to stay. It's annually, you are going to be doing it. And more importantly, it has to be something that is embedded in your own day-to-day budget monitoring and implementation. So it's not something that's going to be detached from your day-to-day business. No, it's about your day-to-day business that you are now reporting more for sustainability aspect of it in the financial statement. So it has to be something that is already or will be embedded even before readiness is demonstrated. It has to be embedded. If you have a strategy section that doesn't discuss more about sustainable aspect of the business, you are doing assumptions, you are doing projections, and you are looking at 1 year. No, you have to look more than 1 year, because this particular standard requires short, medium, and long-term approach to making the assumptions and making disclosure. So you may be having 5-year budget even when you are dealing with 1 year on an annual basis, because you have to look into medium term and long term with respect to how the business that you are thinking about today in terms of strategy is able to sustain and face the reality of future occurrences that is still not yet with us. So, and you need a system to be able to do that. You need the processes to be able to do that. You need data that can help you to be able to do that. And those data has to be comparable on an annual basis. Please move on. So how do you move from awareness to implementation? How do you do that? The first thing is do an assessment of what you are currently, take stock of your current situation. That is the first thing you have to do. And how do you do that is to benchmark whatever you have currently with what are the requirements of both IFRS S1 and S2, and also the requirement of SRG 1, particularly when it comes to readiness. That readiness is very important, and you'll get to hear more about that. It is important that you demonstrate readiness even before attempting to implementation. Please, governance and ownership has to be properly understood. It has to be properly understood the seriousness it deserves, because we are not talking about just financial statement. We are talking about the business resilience as a whole. We are talking about things that are at the discussion level at the board, things strategic to the board interest. What they discuss at the board level is what S1 and S2 is addressing. That is the target of S1 and S2. Those things that affect the strategic objectives and strategic choices that the company makes over the short and medium term, long term horizon is what S1 and S2 is addressing. And there must be proper governance and ownership. Data mapping system must be there. Data is the blood of sustainability reporting here. Data is a blood at any point in time. I've mentioned control framework, which has to do with the internal control over sustainability reporting. Then you have to also pilot it even before you go live, and also make some improvement along the way. So I've spoken to this. The gap assessment is there. What is your current state versus what SRG wants you to do and S1 wants you to do? Do you have missing disclosures? Obviously, if we have people that have been doing ESG before, they will be talking about missing disclosure. But if you have organizations that are just starting from scratch, obviously everything has to be missing disclosure, because we have not been part of ESG all along. They also assess data gaps and process weaknesses. These are things we need to look into before we even come out and apply and send a letter to FRC to come and check our awareness, implementation readiness. Please move on. I've talked about the defined ownership, clear defined ownership. There must be clear defined ownership that speaks to who owns what, who is accountable for what, who is in charge of resource allocation, who is charged of operationalizing it, down to the process owner, that ensure that data flow back to the top. And at the end of the day, also data are coordinated between the non-financial aspect of it and the financial statement aspect of it. These are data that is very important to ensure that we have at any point in time. I give an example of that. We are talking about this Dangote now that came on board, and to my mind, if you listen to Femi Otedola, he told them go and sell your asset. The moment they say go and sell your asset, the reason for that thing is because of the regulation. The regulation is a government regulation, and government regulation is one of sustainability issues that has to be considered. So government says we are deregulating. That is a sustainability issue on its own. And the depot, they are trying to, for now, for me, they are trying to survive. They are not trying to be resilient. They are just trying to survive, but they are not trying to be resilient. So for such organization, they need to understand that it is not survival that S1 is talking about. So it is about resilience. It is about what? Resilience that S1 is what talking about. And they need to understand that they need to own up what that actually means for their sustainability journey as you move ahead. Please move on. I've spoken to the data. Your data must be traceable, it must have owners, it must be verifiable, and you must be able to compare year on year to be sure that the data are good for the reporting that we are talking about. But we are reporting strategic matters in the financial statement that has a connection to the financial statement. Please move on. Again, this is just to provide additional context to what the control will look like in terms of internal control over financial sustainability reporting. Please move ahead. Obviously, you have to test it. You have to be sure that what you have implemented as a whole is fit for purpose, inspection ready, either for the auditor or for even the regulators at the end of the day. Move on. So what does good look like? When you say you have a good implementation, what does it look like? You move from awareness, you move from partial data, you move to a structured defined process, you move to control reviewable evidence, then you are able to demonstrate audit readiness. If you are not able to demonstrate audit readiness, there is still a lot that you need to understand and do with respect to this sustainable reporting journey that we are talking about. Move on. So for me, the best narrative is not driven, your success is not driven by best narrative, it's driven by the stronger data and control system that you have. That is what is driven, not the narrative. We can write narrative. We can go and copy and paste. But at the end of the day, whatever you copy by way of boilerplate, is it supported by data? Is it supported by system? Is it supported by controls? That is the questions your auditors will be asking you. That is the question the regulator will be asking you. And that is the question the company's management and board should also be answering and responding to as we move on in the journey of sustainability reporting. Move ahead. Move ahead, please. Okay.
All right.
So far, so good. By way of conclusion, I just want to mention three things. Number one, this sustainability reporting is about the entire business and it's about resilience of the business. It's not about survival. It's about resilience of the business. That's number one. It's at the level of the board in terms of strategic choices that organizations make. That's number two. Then number three is about transparency of reporting. It's about transparency of reporting, and it's about connectivity of your narrative in the reporting back to the financial statement. If there is no connection between what you say in the report that you are being asked to disclose and what the financial statement is actually saying, then the purpose of sustainable reporting may have not been fully achieved at the end of the day. Thank you very much for your time.
Thank you so much, Akim, for that insightful presentation. I'm sure many of our participants are now reflecting on where the organizations currently sit on the sustainability journey. So a few takeaways from this session is that awareness is not equals to readiness. You might be aware of the sustainability reporting standards, but are you ready? Is the organization ready? Akim has highlighted some steps that can help us to ascertain our readiness and move us from awareness to implementation. So the first step is the gap assessment. You must compare the current state of your organization as against what we have in the SRG 1 and also in the IFRS S1 and S2. Also, you must have clear accountability. You must define ownership as well. Then also you must understand your data. Very, very important. You must understand your data to ensure that you are ready. So it means that you must identify all sustainability related data sources. You assign data owners, and then you map this across different functions in the organization. While the fourth step he mentioned is that we need to build the control framework. very, very important. And the last step is that you must always test before reporting. It means before you can even write to FRC to come and assess your readiness, you must test in-house first before you do that. Thank you once again, Akim, for helping us understand that these are sustainability requirements. Is not just a requirement, it is what is expected of organization and what we really need to do in practice for us to be truly ready for compliance. Thank you so much. So this is to remind us that if we have any question, we can always use the chat feature to drop our questions. We will address all questions during the course of the session. So Akim has provided a perspective from the practitioner point of view. He has provided a practitioner's perspective of the sustainability reporting. Now we want to go into the regulatory and compliance, and we have a speaker that would help us do that. So he's going to share insights into SRG1, the regulatory expectations, and what organization needs to do to align. Dr. Abdulrazak Abubakar is the head of Sustainability Reporting Regulations at Financial Reporting Council of Nigeria. He holds a PhD in accounting from Nasarawa State University, Kefi, and is a fellow of both the Institute of Chartered Accountants of Nigeria and the Institute of Chartered Secretaries and Administrators of Nigeria. He has over 15 years of professional experience spanning the financial services industry, private sector, and public sector. He has worked with reputable organizations, including FCMB Bank PLC, Sterling Bank PLC, among others. Over the course of his career, Dr. Abubakar has built extensive expertise in financial reporting, audit and assurance, and regulatory compliance. He is also an active researcher and technical writer with more than 12 publications. We have Dr. Abubakar with us today to run us through the regulatory and the compliance perspective of the sustainability reporting. Dr. Abubakar, over to you, sir.
Okay, thank you very much. Let me thank Transact Chartered Accountants for this wonderful opportunity to bring together stakeholders to interact on the sustainability reporting, which is becoming an integral part of financial reporting. Just like Akim has actually asserted, uh, come 2028, you can no longer prepare, your financial report without, sustainability report embedded in it. And it's my pleasure again to be part of this program by eTransact. Thank you very much. Okay, a moment, please. Okay. Okay, please, I want to share now. I don't know whether I can share now. Okay,
You can go ahead, sir.
okay. Okay, can you see my page now?
Yes,
I'm sharing. Okay.
yes, sir, we can.
Okay, thank you very much. I thank Transact for putting this together, which, like I said, is very good one expected of a professional assurance firm to cascade knowledge about information about what's required. And like I said, by 2028, we are going to have a change of narratives in financial reporting. Because of sustainability reporting, we are actually part and parcel of financial reporting, and your financial reporting will not be incomplete. In fact, your financial statement will not be complete without sustainability reporting. My name, like you heard, is Dr. Abubakar Razak. I'm the head of Sustainability Reporting Regulations in the Financial Reporting Council of Nigeria. So we want to talk about the FRC roadmap and SRG. And what is a roadmap? What SRG? In 2023, Nigeria actually we had issue with the disparate nature of sustainability reporting. And because of this, we at COP26 in Egypt, we declare our early intention to adopt the International Sustainability Standard Board Sustainability Reporting, moving away from different fragmentations that we have. And that's what led to in a roadmap. So an overview of what I'm going to have now, my goal is just four. One is to have an overview of that FRC roadmap, and we need to identify different stages of in the roadmap, and we're going to discuss the requirements of the adoption readiness test. Then we now assess our readiness. We'll assess our readiness regarding what the SRG is talking about. We look at various relief as provided by the standard. Just like I was saying, before now, sustainability reporting was not that regulated. And sustainability started from what we used to have as a means of public relations, where people consider it as giving back to society from what you have gotten. And this is very, it's justified because a business is an open, a business is an open system. You have to interact with the environment to get your input, and you give out the output to the environment. So between your input and output, organization generates what you call externalities. Externalities is the impact of organization on the environment. This externality could either be positive or negative. So, and because of this, the CSR gesture was justified that our organization is giving back to society what it has gotten from it. So, and this is how sustainability started in the first place, like a means of public relation to develop a relationship with the public based on externalities the organization is extending and giving to the environment. So after that, sustainability reporting moved from being a public relation to what? A nice to have. Companies started having it because it becomes necessary that it's not just about public relation alone. Let us have it to tell our other stories that were not covered by the financial reporting. And later it becomes, a competitive advantage. Where those who have it, those organizations that actually have sustainability reporting have advantage in terms of stakeholders, engagement compared to those who did not have it. And then later it become a disclosure requirement with the coming of GRIs and other standard setting bodies. GRI is the Global Reporting Initiative. So GRI came with their standard, but most of the standards are largely voluntary. They were not made mandatory. In other words, nobody will penalize you if you don't use GRI to report your sustainability or your CSR. So with the coming of ISSB, it now becomes mandatory, to report sustainability reporting in a way that is more accountable, comparable, and transparent. And before now, there are different methods of, people see sustainability reporting. They are not comparable. And this is one of the concerns of the Financial Reporting Council of Nigeria. When we review financial statements, it is difficult to compare apple for apple. Just like you can compare the financial reporting using the IFRS, which is globally based, reporting framework. So now, as a last count, we have more than 60 framework for sustainability reporting. And it becomes a problem, not just for regulators, but for investors, even the practitioner, to look at various comparability of entities. It becomes very difficult. So with the birth of ISSB in 2022, Financial Reporting Council of Nigeria was so happy because it's going to solve a problem that we have considered a regulatory problem, and it's going to solve a problem for investors because ISSB is regarded as a global baseline, meaning that it's going to be adopted by over 140 companies that are already applying the IFRS worldwide, and it will make sustainability reporting, comparable, accountable, and transparent. So when we came back from Egypt, where we declare our island adoption, we formed a group called Adoption Readiness Working Group, ARWG, comprising of major stakeholders, regulators, the government organization, private organization, and experts in sustainability reporting to look at the S1, S2, and how Nigeria will actually adopt sustainability reporting. And having worked for 8 months and with rigorous webinars, physical meetings, online meetings, the body came with a roadmap, which is a guideline, a strategy for adopting sustainability reporting in Nigeria. So, uh, as we are working on the roadmap, the ISSB was launched in Nigeria precisely March 22nd, 2024, where the chair of ISSB was in Nigeria, also with the president and Lagos State government to actually support the work of IRWG and the adoption in Nigeria. And the Financial Reporting Council of Nigeria received the backing of federal government for the adoption of ISSB as a national guide. Yes, a national guide. In other words, Financial Reporting Council of Nigeria, federal government of Nigeria officially adopted the ISSB standard as a global baseline, which will be expected by organizations mandatorily by 2028. So let's see the highlight of the roadmap that we have seen. We have timeline for reporting, release, also readiness test, then location of disclosure, the disclosure sustainability information and assurance. So this is a roadmap. Roadmap is the first document that was released so that it will highlight what Nigeria interpretation of the standard and what Nigeria wants to do with standard. For example, if you look at the IFRS S1 and S2, the idea of the standard was to be implemented globally by 1st January 2024. But in the thinking of ARWG, the fact that there's a need for us to have a kind of a readiness before we can adopt it. Because lack of, when you don't prepare, then you are preparing to fail. Therefore, the FRC think that it is better we have a stagger, a phased implementation program. And that's what the ARWG in their thinking adopted. And that's what is contained in the roadmap. So after roadmap, the first roadmap was released in 2024. And by 2026, February this year, we had an amendment of a roadmap, which is already in circulation. What informed the amendment is the development that we have seen between 2024 and 2026. Also, ISSB introduced 2 exposure drafts trying to amend what is in the IFRS S2. So the Financial Reporting Council of Nigeria called the stakeholders across Nigeria to come together and have their say. And we had amendment. And that's what led to some of the amendment we are seeing in the roadmap 2026. Also, we introduced SRG. SRG is Sustainability Reporting Guidelines, which came up as a result of a questioning inquiries from practitioners and preparers about to shed more light on certain areas of the standard. So that's what led to these 2 documents. And what we are finding in 2 of them regarding the phase for reporting, and we also have phase for assurance, just like Mr. Kim is saying. Out of this first phase, we have phase 1, which we call early adopters. Like I said, the standard is supposed to be effective by 1st of January 2024. But in the thinking of ARWG, they felt that there's a need for Nigeria to prepare. So we introduced a phased implementation, whereby we have different stages of implementation, and every entity that's ready can enter which of the one it prefers to enter based on the readiness. The first one is early adoption. Those who wanted to even adopt the standard before it becomes effective. We said its effective date was January 1st, but this organization, they decided to even adopt it before it became effective in 2024. In other words, they started the adoption by 1st of January 2023. And we had the likes of MTN, Seplat, Access Bank, and Fidelity Bank, who demonstrated to the world that they were early adopters. So, and after that, the second phase is between 2024 and 2027. The window of second phase opened 2024 through 2027, meaning that organization that wants to test learn their ropes, it's not yet mandatory, but organization already, so that by the time it becomes mandatory, they will be used to the requirement. So the openings, this window opens in 2024 and is closing next year for organization to actually do it, apply it, even because it becomes mandatory. And the idea is to learn some of the rudiments without being penalized, unlike when it becomes mandatory, where infraction will be penalized. So as we speak now, the phase 1 and phase 2 we have more than 50 companies in Nigerian company that are on the verge of reporting full IFRS S1 and S2 for 2027. And we're going to see some of them, we're going to publish some of them in our social media and newspaper maybe by next 2 weeks. So now we have phase 3. Phase 3 is mandatory stage where it becomes mandatory for all PIEs and including commercial public sector entities, formerly referred to as GBEs, and phase for SMEs, which is for 2030. And one thing I want to make clear is this, that early adoption is encouraged at all stage. For example, for SME, that is 2030, we have seen some serious, let me use the word serious, and aggressive entity that are SMEs. They want to do it start now because their trading partner in UK and Europe are demanding that they must tell the stories of their sustainability reporting, their financial reporting, and they apply to us, and we allow them to go through the readiness test, and they pass. And they are now, we have about 3 or 4 SMEs already joining. So irrespective of this roadmap, entity can join, do early adoption, do earlier, which is encouraged and start a certain process. And of course, the first phase is the government and government organizations. For those government that are using IFRS, IFRS is the framework used in the public sector. Those organizations, because they have their own standard setting body, IFRS B, International Public Sector Accounting Standard Board, as usual, is standard, IFRS B, SRS 1, Sustainability Reporting Standard 1 on climate. So those are to apply IFRS B. So they are all going to be effective for 2028. So these are the 4 stages that we have. So by January 1st, 2028, we're expecting all companies in Nigeria to comply with sustainability reporting. And this means a lot of work for a lot of assurance firms, because a lot of them will be doing their financial reporting now to have sustainability reporting as part and parcel of it as demanded by the regulation. Now, just like we said, we have some early adoption, and the types of MTSA plus iceberg fidelity that are actually platform something, and we have more than 51 companies now on the verge of a voluntary stage. So, but what FRC is emphasizing that we don't want organizations to just start it, because we don't want greenwashing. We don't want organizations to producing what we have used to in the past, where organizations will spend 1 million naira to dig a borehole, and they will now spend 10 million naira to advertise it, to put on the pictures. Where financial reporting will be full of pictures that has nothing to do with understanding, of the standard. Where organization will just be hiding information, which is affecting qualitative characteristics of financial reporting, understandability. They give information that are immaterial, irrelevant, in order to cover those information that are material. So all these financial reporting council of Nigeria have seen it. And we are saying now, for you to be able to say you want to do sustainability reporting, come and do a readiness test. Readiness test is nothing but a requirement that you should submit certain documents for financial reporting council of Nigeria to be comfortable that organizations are actually ready to do sustainability reporting. And readiness test assessment is compulsory for all entity, irrespective of the phase, of the adoption stage. In other words, an organization cannot just decide on their own now, because we are watching financial statement that's been released. You can do GRI, it's not compulsory. You can do your photo system that you are used to, but to do ISSB, FRS S1 and S2, you need to come through Financial Reporting Council of Nigeria and do a readiness test, where we are going to ask for certain documentation for us to be able to be comfortable that you are actually ready. So there are 17 documents that we actually require, at different strata of, timelines for financial reporters to look at this document and see that organizations are ready. The first one is to be submitted 3 months before the beginning of reporting date. 3 months before the beginning of reporting date, meaning that for 2027 financial year, those who run January to December 2027, 3 months before the beginning of that reporting is the 1st of October this year. So it's expected that any organization that wants to do reporting by 2027 should approach us by October to submit these 3 documents first, to indicate their interest, that they want to do assessment readiness test, and they want to do sustainability reporting by 2027. The first one is board resolution, approving the adoption of IFRS Sustainability Disclosure Standard, gap analysis, report, and the implementation plan. Why board resolution? It is important that sustainability reporting now can actually be defined as a failure or a success depending on the board support. At every strata of the sustainability reporting, you are going to need your board support. So we want the board to take a decision by way of resolution that they are going to support sustainability reporting of the company. We don't want the staff to be aggressive and be ambitious to do it while the management and board are not in support of it, because this is an holistic information about risks and opportunities of organization, enterprise risk management of sustainability reporting. Therefore, the board must actually support it. So you need to support your board resolution, which will be a board decision that the company, the entity, is going to do sustainability reporting. The second one is a gap analysis, just like what Mr. Hakim has just said. You look at your current practice now, and you compare it with 220 requirements of S1, S2, and then you now come up and say, this is my gap and I have, and you tell us how you're going to fill this gap. Of course, you have to do that with a plan, with timeline, and to give us the implementation plan, how you're going to do this. Financial Reporting Council of Nigeria will look at these requirements, and where we have feedback for you based on your submission, whether your implementation plan is realistic or not, Financial Reporting Council of Nigeria will get back to you. Otherwise, you'll be contacted to go with the second phase of the submission. Now, the second phase of submission has 6 requirements, and you'll submit that 3 months after the beginning of the reporting date. Like in my example, a company running a January to December financial period, so more than 3 months after the beginning of the reporting date that's March of 2027. You ought to submit the second stage document. And what are they? IFRS Sustainability Disclosure Standard policies. You must have a policy for IFRS standard, because what you translate to reporting is your sustainable practices. If you don't have sustainable practices on ground in your entity, you'll be doing greenwashing, because you'll just be writing stories at the end of the day. Sustainability reporting has to come with data that are gathered not just by December, but day in, day out activities of the company. And the organization must have a policy how you do ESG in your offices. So you must have a policy. And again, number second, identification and application of transitional relief. The standard gives some reliefs by virtue of the standard. So you need to look at S1, S2 and look at those reliefs, and then you tell us which one you want to enjoy out of it and which one you want to you don't want to leave. For example, the standard allows you to separate. The standard says your sustainability reporting and financial reporting must be together. Your sustainability reporting and finance must be the same thing in financial reporting. Therefore, but for year one, for the first year, you are allowed to separate it to publish 6 months after your normal financial reporting, because of the the timing and the struggle. But if you are not taking this advantage, we have seen some organizations say, look, we are going to do it together. Some organizations have separated it. So the section 2 is saying you identify these transitional reliefs given by standard, then you tell us which one you want to apply there. Then the second document, identification of material assessment of sustainability and climate risk opportunity. You need to understand your material assessment. You need to do a material assessment and identify those areas, that your sustainability dimensions that has to affect your business, and you need to identify them. Because one of the beauty of ISSB standard, there's this industry-specific disclosure. What a company A may be disclosing in terms of requirements, industry-specific, may not be what company B is, depending on the industry. For example, somebody or an operator like Seplat, that's oil and gas, and organization like Fidelity in banking. So their assessment materiality will be different. So organizations must tell us this in their submission. Then evidence of establishment of a governance structure for sustainability reporting. Many companies don't have a committee responsible for sustainability reporting on their board. And this is where the problem lies. Sustainability reporting used to be seen as a cost center, and those who do it just come to take, so they are not being taken serious. So we want to see the seriousness of your board, of the board organization, to discuss sustainability issue on the board. Of course, it's not necessarily that a company must have a designated sustainability reporting, but if a particular or similar board committee is already doing this work, that can be taken. For example, risk management committee, governance committee, provided they will be doing sustainability issue. Then we must have evidence of board approval of this IFRS Sustainability Disclosure Standard. That is, a board must approve it. Not just we have a lot of companies give us a company-wide ESG practices that's not approved by the board, that's not being followed, then the board must actually approve the IFRS Sustainability Disclosure, which is very important. And what is approval? Just a board resolution that the board has also did approve this IFRS Sustainability Disclosure policy to be followed. The number 6, evidence of regulatory sustainability upon training. And this is a very key. It's a training that is a regulatory training, and it's not like any other training, operational training. This training is conducted by Financial Reporting Council of Nigeria as a regulator in conjunction with organizations that we have an MOU with. Currently, we have an MOU with one organization, and this can be expanded in the future. The essence of this training is to bring down regulatory issues in the S1, S2 and bring it to the information of the board members in terms of what are the requirements of the board, such as the establishment of a governance structure and the support that the organization may need, in the sustainability reporting for the company. So, but this does not preclude entities, auditing firm, accounting firm, training firm doing their normal training in IFRS Sustainability Disclosure. In other words, this training is purely regulatory, and any other training that has to do S1, S2, organization can go on and back on. So this will be submitted 3 months after the reporting date, beginning of reporting date. That is, for a company running January to December, we expected this to be submitted by March, for the second level submission. In mind you, the first level submission had been submitted, October the previous year. Now, the third requirement is evidence of registration of the entity and professional. If it depends on the organization, we have seen some organizations that have classified sustainability reporting as part of the enterprise corporate research, where the CFO, Chief Financial Officer, is still signing. So where we have somebody already who is signing financial reporting, and the person has the FRC number, he does not need to have a new FRC number. But we have seen some company where they separated the sustainability issue from financial reporting. So where the person is preparing sustainability reporting, then somebody that's editing sustainability reporting as part of sustainability reporting has to sign. That person, who if he does not have a number before, must actually sign, put his number there. So we have seen a company like MTN, they have a separate sustainability people different from the chief financial officer. So in that connection, you are expected to put their FRC number there, and they need to actually register with Financial Reporting for Nigeria. Then number 2 in this submission, which is not more than 6 months after the beginning. That's June. For example, many companies last month tried to submit their last version. So all these will be submitted, description of model used for scenario analysis, enterprise and sustainability risk management. Well, on number 3, many people made mistaken to be we are acting of ERM framework. No, we are not asking for enterprise-wide risk management. We're asking for those areas of ERM that actually affect sustainability reporting should be extracted. The evidence of board approval of enterprise, board must approve it for sustainability reporting. Description of cross-industry and industry-specific metrics target. Yes, like we said, every industry has industry specific to be disclosed. For example, even if you are operating in oil and gas, you have those industry specific that are peculiar to you. And unlike somebody in the banking industry, even in ESG, they have different ESGs that are peculiar and certain dimensions. Let us see this for us to be able to know what you are going to be reporting. So once you cannot get this, give us clear picture that you are not ready for sustainability reporting, and we are going to write you to bring it and do the needful. Then this must also be approved by the board. Then current financial effects, sustainability related risk and opportunity, and finally internal control over sustainability reporting. Now I need a little clarification on the whiteboard. When we talk about board, you see that most of these board documents of safety, about 4 documents are board. The reason is because we are trying to allow the board to take the lead and take responsibility and ownership of sustainability reporting by giving the necessary support to the sustainability officers and even to consultants who wants to know. We have seen from our experience that most boards don't see sustainability reporting the way it is now. They used to think the way it was when it was CSR, nice to have. and the things they cost center. So let us just ignore them. Now, the board are more than ever before aware of their responsibility in sustainability reporting, particularly for the company that are this adopted company that we're having now. And for internal control sustainability reporting, we are not trying to create another SFR here, but what we are trying to do, we want there a linkage between internal control to most of the document that will be generated, like in data gathering, data mining. They should pass through a second hand, an independent body in-house, for validation, before it's finally given to FRC or to auditor. In other words, this to let organization be ready, assurance ready when it's become so that they have this idea of verifying data. Because when you get your scope 1, scope 2, scope 3 emission, or you tell your auditor that we have done 45,000 liters of fuel, that's what we have purchased. How do we translate to GHG emission? Somebody must confirm actually that 45,000 liters that you are bringing to your sustainability report is actually true. So internal control will actually be there to confirm this, verify this, and validate it. This is just a test for you to be ready for assurance, because assurance is coming, and the assurance people will actually go through and ask these questions. So these are the requirements the organization needs to submit. And once you are through with this, and at every stage that we receive this document, we review them, rigorously, and we get back to you if you have any feedback, or we can return any of them to you. There's no way prepared, and we have had cause to reject entirely some reports that are not complying with sustainability, and it shows that the organization does not know what it wants to enter to. So we did not allow them. We tell them to go and do this and get prepared for. And so these are the requirements. So once an organization submit this and we're satisfied, we give them opportunity to go ahead and prepare their sustainability report for the year from June to December. So these are the requirements. Now, when it comes to assurance, assurance is not immediately. One of the reasons why assurance was delayed, the reporting, the framework for assurance came with this year. It's going to be applicable this year. The International Audit and Assurance Standard Board just issued ISA 5000 this year, and it's going to be applicable by December. So that's why we actually delay the assurance, or in other words, we delay it so that organizers can do internal control, internal mining data within their organization for them to be used to assurance. So we are expecting assurance on the 4th and 5th year after reporting. In other words, your year 1, year 2, year 3 will not be assured. We rely solely on your internal control to validate some of this data. But by 4th year and 5th year, you are expected to get an assurance firm to do your assurance for you, starting with limited assurance, which is a less rigorous form of assurance. And you are doing verification of S1, S2, but you are excluding scope 3 emission. You are excluding scenario analysis and transitional plan. You are going to exclude from the assurance. So assurance person is not responsible for those. They are supposed to limit it. So it's limited assurance. But on the 6th year, you are expected to do reasonable assurance. You are going to verify the S1, S2 disclosure, but you are going to excluding scope 3 again. And limited assurance of scope 3 now with scenario analysis and the transitional plan. Then by 7th year, you expect to do full reasonable assurance, which is the most rigorous form of assurance, covering all the verification of all disclosure, full quantitative and assurance. So these are how the assurance, look like. But however, just like we like to use the standard setting language, early adoption is encouraged. For example, we have seen some organizations that say, look, we want to do assurance now at year 2. So it's allowed to report. You have, but the standard to use ISA 5000 with the auditor, the assurance company is aware of, that's applicable by December this year. So these are the other I was talking about relief to be enjoyed, transitional relief, climate first. The standard requires climate first reporting. While you are paying attention on other ESG dimensions, the standard actually encourage you to report climate in your first year, while you are giving other dimensions, opportunity. Then you are also giving relief to remove or ignore Scope 3 GHG emission. Scope 3 is the emission of the value chains that has to do with your suppliers, your employee commuting from office, employees travel, supply of goods and services. Because of the data that you may need, the standard allows you, give you relief to omit it, to not to report it in the year one. Of course, in year two, you have to report it because it's expected that you need to have some time to identify your Scope 3 suppliers to gather it's somewhat rigorous. Because of this, the standard allows you to relieve, not to report Scope 3 in your year one. So, and is a given, it's a standard, it's a relief that's been given by the standard. Another is timing of report. Timing of report. You are expected to submit sustainability reporting with financial statement as part and parcel of general financial reporting. As part and parcel of general purpose financial report. So you must submit them together. However, the standard give you relief in the year one to separate it if the company wants to enjoy it. For example, if you run January to December period, you can wait 6 months, June, the previous, the next year to do your sustainability report as a standalone document. This is allowed in the first year only. Subsequently, is not allowed. We are supposed to be pattern, but we have seen some company that say no, we want to, we don't want to take this relief. We want our sustainability report to be reported as a document so that our investors, our stakeholders can see it as one document. But standard actually allows it because of the timing. Another relief that have been given is comparative reporting. If you have been using a framework other than ISSB framework before, you are not expected to do comparison of those figures, comparative information of those figures in the new one you're using. In other words, just give us the current information without comparison. That's what the standard is saying for the year one. Don't do comparison. But when you are doing year two, you can now compare. Because the framework you may be using before may not be comparable with ISSB. Say you are using GRI or CPD or TCFD or TNFD or SASB, they may not be compatible with the requirement of SASB. So the standard allows you relief to not to do comparative in the year one. Of course, in the year two, I am going to do it. Then GHG protocol use. This is another relief by the standard. The ISSB, for you to calculate your emission, we expect to use GHG protocol. So GHG protocol is allowed to be used. Although now the amendment that I talked about earlier has now brought a change that organizer can use any other methodology, provided you give fair presentation and faithfully represent the information it proposed to represent. So, but GHG protocol is allowed, but then say no, if organizers have been using a particular method before, like PCAF for banks, so they are allowed to continue to use it pending when they will fully transit. Then we have location of disclosure. The standard allows sustainability reporting to be located in a particular place in the financial statement. As you flip through financial statement, there should be a designated place where you can locate sustainability reporting with a beginning and a end and must be signed. There will be statement of compliance. So the ARWG, in their wisdom, have asked company to place sustainability reporting after director's report before the financial statement. That's where we are likely to find slap. So any company who is not placing it here, then that company is committing an infraction. So when you pick financial statement, financial report, annual report now, immediately after the director's report, the next thing you are going to find is sustainability report before the financial statement, before you go to profit and statement of financial position and the rest of them. So we need to find sustainability report. The idea is for compared to enhance ease of comparison and comparability. The index of referencing, so the standard also gives a relief that, look, you don't need to continue to repeat information. For example, a lot of them do sustainability reporting, governance, corporate governance report, and other similar reports. You don't need to come and be repeating those documents. You can do indexing to reference those to guide against duplications in the financial statement. Investors don't have time to read over 200 pages. But where you have information that are given over leaf, you can actually reference it in the report. So, like I said, SRG 1000 is the framework to be used for the assurance of sustainability reporting. Now, let me now come to what is concerned most of the assurance firm and the firm, and this is very, very key. Financial Reporting Council of Nigeria in the SRG have outlined certain qualifications for those people that will give assurance to entities about sustainability reporting. For an employee of the company that's a sustainability reporting officer, all you need to do to register FRC is for the company to introduce you that you are a sustainability officer of the company, and you come to your qualification. FRC will register you with a number as an employee of the company. But for consultants who are giving assurance, who are assurance giver as consultancy to individual, the FRC recognizes that they must scale up and have required qualification. For example, sustainability reporting is a multidisciplinary activity. Like Akim has said, it's a very multidisciplinary. Accountants who are welcome, other professionals who are welcome. So the Financial Reporting Council of Nigeria has recognized these professional bodies to be the gateway to be able to practice sustainability reporting. One of its member of ICANN. If you're a member of ICANN, you have a gateway to actually practice and consult for sustainability reporting. Number two, member of ICSAN, that's Institute of Chartered Secretaries and Administrators of Nigeria. So you have a gateway to practice sustainability reporting, and a member of ANAN too, and member of Chartered Institute of Directors, IOD. And also members of sustainability professionals such as environmentalist, energy experts, climate change experts, water management experts, carbon accounting experts, etc. We have an organization that people that are independent professionals in this field. So when they have this qualification, they can actually render concern service. But such member, this is very key, such member, in addition to membership of the above professional body or members, they must hold a qualification that's acceptable to financial reporting. And after you have this above, then there are some qualifications that you must have again, that the acceptable financial reporting council of Nigeria, for us to be able to be comfortable that you can do assurance in the sustainability reporting, because it's different from GRI now. It's different from what you have now, because now we have connectivity with financial statements, connectivity with financial information, connectivity with IFRS standard. Therefore, the person that will do it must have this qualification. Having had this above qualification, then the acceptance qualification has actually accepted FRC is number one, FSC credential holders by IFRS Foundation. IFRS Foundation created this professional link specifically to prepare people for S1, S2. So it has two stages, level 1 and level 2. So many consultants are already on the verge of completing it, and they are already part of those people that will recommend it. So in other words, it's not enough to be an ICA member and say you want to assure some ability. It's not enough. It's not enough to be ICSA member of IOD. You need to have some updates, some qualification that will be added to it. And one of it is FSC credential, run by IFRS Foundation themselves. They have level 1 and level 2. Once you complete level 2, you can actually assure. The second one is the professional development and sustainability. It is run by ACCA online, and it's a first suit professional modules. When you finish it, then you need to now write a case study before you get that diploma. So the next one is CFA certification in climate risk valuation and investing. And the fourth one is the ICAO sustainability certificate. So entities engaging sustainability professional and firm for sustainability assignment must request evidence of their registration with the FRC. So as it's a requirement now of the company that before you engage anybody, you need to ask them, let me see your registration with it, because we don't want quack to enter this discipline. We don't want people who are not capable to do it. We don't want people to be doing greenwashing. Mind you, Nigeria has projected our flag worldwide that we are the first to do it in Africa. So the company that will do it, the reports are international, and every report can be seen from anywhere. So therefore, we don't want anybody to bring that flag low. Therefore, we want professionals we are sure to know what they are doing and be able to follow it up. So in conclusion, the Financial Reporting Council of Nigeria is at the vanguard of encouraging organization to adopt sustainability reporting. And that's why we have created the phases that we have. Fourth phase, early adoption, voluntary stage, mandatory, and the phase for public sector. And we're also continuing to render support for organizations, including professionals, so that we can have interaction and discussion such as this to further the interest of sustainability reporting in Nigeria. And we are also encouraging professionals to discuss with us on area of their need in terms of support, and we continue to handhold many organizations in this collection. I thank you very much, and God bless. Thank you
Amen.
very
Thank you.
much.
Yeah, thank you so much, Dr. Abubakar. Thank you for that enlightening and highly informative section. So, a key takeaway for me is that sustainability is now becoming an integral part of financial reporting, and all organizations is encouraged to start preparing towards full adoption by 2028 it's going to become effective. So all organizations are mandated to comply fully, and the only way you can be rest assured that your company is fully compliant is if you take the readiness assessment test. Dr. Abubakar has listed out the documents that is required for each stage. So this is a wake-up call for all organizations that we should take this very, very serious. Compliance is now closer than we think. I mean, 2028 is around the corner, right? And Dr. Abubakar has also mentioned that early adoption is encouraged. So let's work towards this so that we can be compliant. Thank you once again, Dr. Abubakar.
Thank you
Thank
very
you so
much. Thank
much.
you.
Yes, sir. So we'll move right into the question and answer session. So I can see we have two questions on the chat box. So these questions are for you, Dr. Abubakar. So I'll start with the first one. So Ogechi is asking, she said, these requirements seems onerous. How do you advise companies to approach this so that it doesn't interfere with the normal business activities?
Okay, thank you very much. The requirements, sustainability reporting itself is something that's good for the going concern of the company. And we have seen now how investors are using sustainability reporting as an investment choice. You have to investment that have similar financial characteristics, but what will now give an investor a preferred choice is sustainability reporting, the ESG issue, in terms of energy emission, energy management, in terms of social structure and governance structure. For example, you want to know, for example, two companies, energy is a cost. And if there are two companies having similar characteristics, one spending 50 million on energy costs, the other one spending 20 million, you know that the other one is having sustainable practices. So organizations now judge not just about how much profitability you have made, but how much survival, how much sustainability, how going concern the organization will arrive. And this is our center on sustainability dimensions in terms of social diversity. For example, you want to invest in a company and on the stock exchange, all the board members are from a particular tribe, no women. So it gives you a sense of concern that that company may not consider the interests of all stakeholders in terms of diversity. So in terms of management of resources too, and in terms of versatility of management. So all these are what investors are looking for. The BlackRock of this world, who have asset under management in trillions of dollars, they softly look for this, invest in this socially responsible investment pattern of company, and this attracts investment. So it's not a burden as seen. It's something that is the practices are already there, but they are not being reported. So now IFRS is saying, look for this information, report it in the manner that is required by the standard, and it's be good for it. I give you an example of three companies, SME company and Nigerian company that have dealings with a company in UK and Europe. And they are saying, please, FRC, help us, let us do sustainability reporting, please. Even though we have to do 2030, our investor partners abroad want us to do ISSB. And they say either we can't do, they won't do it. We said, look, go ahead and do it. And they submitted their report. And they are part of 51 companies that we are holding now for sustainability reporting, meaning that sustainability reporting is becoming a trading requirement. It's becoming, for example, let's talk about scope 3 that I need to get information from my suppliers. If many companies are not putting their procurement policy, procurement requirement to deal with companies with ESG practices, Because if you are dealing with company without safe practices, to get your scope 3 data will be difficult for you. And you don't want to go through that hell. Therefore, it's becoming a survivor for business. So it goes beyond a body. It's not a body, it's a practice that organization must actually imbibe.
All right, thank you so much, Dr. Abubakar. So there's a follow-up question to that. So Ogechi is asking, she said, does this ultimately replace the going concern assessments usually included in the financial statements? So I want to
No,
believe she's talking. Okay, go ahead, sir.
no, sustainability reporting does not, there are linkages between uh, sustainability reporting and financial reporting. There are linkages, just like Mr. Akima said, and that is the fact. Let me give an example. If you have an organization that has two regulatory penalties in the financial statement, you look at operating cost and you saw that there is a regulatory penalty, fines. And you go down again in the chairman's report, you saw that there are two disruptions caused by host community during the year on that report. One, they have two regulatory penalties as fine. The other one, they have two disruption. And you want to invest in two companies. The other company does not have any regulatory fine. They didn't have any disruption this year. So which one would you invest in? You will invest in the one with that is keeping to regulatory, rules and regulation. It's complying with CBN, FRC, NICOM, PENCOM, and it doesn't have any regulatory fine. The one that's having fine is risky. It can run foul of the law, and there can be, if the bank can lose its license, or so it's a signal for going concern. Although it's a signal when the organization having operational disruption for 14 days, this is a very serious one. When you close your operation for 10 days, it's something that it starts, you must lose some money. So it has to do with going concern, and it's a very serious issue.
All right, thank you so much, Dr. Abubakar. Thank you for that comprehensive answer. So I have a question for Akim. Akim, talking about the assurance journey. We know assurance escalates from limited to reasonable full assurance over years 4 to 7. What should the entity put in place from day one so that later deeper assurance is not a shock to them?
All right, I think the first thing we need to understand is the thin line between limited and reasonable assurance is the extent of assurance work to do. So from a management point of view, the organization should not think in the line of limited or reasonable, because you cannot provide and implement data and all that just because you are having a limited assurance construct. So from day one, the construct that you are building into your implementation is a reasonable assurance, because there is no half data that you can say supports limited assurance. From an auditor's point of view, what they do and they call limited is they are not doing detailed work. They are not doing detailed work, because that is what limited assurance means. I'm not going to do detailed work. I'm going to look at what you have done by way of implementation and ask myself whether there is something that has come to my attention with respect to whether your disclosures are not as it were. So I'm not going to do too much of work. But when I'm doing reasonable assurance, I'm going to do independent testings and assurance work. So it's about the level of detail of work that is going to be done by the assurance people. But from the company's point of view, you don't prepare for limited, and later you say you want to prepare for reasonable. You prepare for the eventual full-scale assurance, so that when it's time for limited assurance, that is the assurance people to decide. It is not your own call. The extent of work is the assurance people's call, not your call. So you don't have really a room to say you want to implement for limited assurance point of view. and then later you implement for reasonable. Start from day one, implement with the expectation that your entire implementation scope, your data, your board resolution, everything, your system is robust, is ready for independent testing by the assurance people. That is what I would advise organizations to do. It's not difficult. It's what you are just doing. As you are implementing, your mindset is auditors may want to perform full-scale independent testing. So I need to ensure my data is foolproof, is ready for that purpose from day one. And that's what I would advise organizations to do.